All right, let's talk about something that affects every single one of us. It's like a silent thief, a force that's constantly nibbling away at your bank account, influencing huge government decisions, and really shaping your entire financial future. We're talking, of course, about inflation. And today, we're going to piece this puzzle together. I mean, seriously, you get that awesome pay raise, you're feeling good, but somehow your rent just seems to be in a completely different race and it's winning. That feeling, like you're just running on a financial treadmill and not getting anywhere, that's the exact puzzle we're going to solve today. You're not imagining it. So what is inflation, really? It's not just your favorite coffee getting a little pricier. The keywords here are everything: widespread, permanent, and sustained. This isn't just one thing going up in price. It's a general rise in prices across the whole economy, and it keeps on going. The dollar in your pocket is still a dollar, right? But its power, what it can actually buy you, just gets weaker and weaker. Okay, let's clear a few things up because these terms get mixed up all the time. You've got inflation, simple enough, prices go up. Then there's disinflation, which means prices are still going up, just not as fast as they were before. But the really weird one is down at the bottom, deflation. That's when prices are actually falling. And look, on the surface, that sounds amazing, right? Cheaper stuff for everyone. But in reality, it can be a total economic nightmare. Think about it. If you know that new car or TV is going to be cheaper next month, what do? You wait. And if everyone waits, spending just grinds to a halt. That can sink an entire economy. So here's our roadmap for today. We're going to start with the big idea and how we even measure this thing. Then we'll finally solve that rent versus salary puzzle. After that, we'll dive into where inflation actually comes from, what governments can do about it, and probably the most important part, what you can do to protect your own money. Right, so to fight inflation, you first have to measure it accurately. The way we do that is with something called price indices. You can think of them as the economy's detectives. They're out there tracking a basket of common goods and services to see exactly how their prices are changing over time. And in Brazil, we've got two main detectives on the case, and they cover very different beats. First, you have the IPCA. This one tracks the price of a typical consumer shopping cart. It's the official rate, the one the government really keeps its eye on. But then you've got the IGP-M. This one's focused more on things like factory costs and production. It's often called the rent inflation, and we're about to see exactly why. And this chart right here, this is the smoking gun. This shows us exactly why these two indices are so different. Just look at that huge purple slice of the pie for the IGP-M. A massive 60% of it is driven by wholesale prices. That's what factories pay for raw materials. The prices you and I actually pay at the store, that's just that smaller green slice. This is the absolute key to our whole puzzle. All right, so now it's time. Let's put all the pieces together and solve the big mystery. Why does your rent seem to skyrocket while your salary just kind of inches along? Well, the answer is all in this tale of two very, very different indices. This table lays it all out, nice and clean. Your salary, or at least the negotiations around it, is often tied to the IPCA, and as you can see, its focus is on the final consumer, your groceries, your gas, that kind of thing. But your rent contract? That's almost always tied to the IGP-M, which is focused way, way back in the production chain. It's measuring things like industrial metals, agricultural commodities, and how the currency is fluctuating. They are literally measuring two completely different economic worlds. And this right here, this is the aha moment. Let this one sink in. Your rent is priced at the factory gate, where costs can be incredibly volatile. But your salary is priced at the supermarket checkout. They're speaking two totally different financial languages. And that's exactly why they feel so disconnected from each other. And here's what that looks like in the real world. Just a few years ago, when global commodity prices went wild, the IGP-M shot up over 30% in a single year. Now, just imagine your rent going up by 30%. Your salary, which is tied to a much, much lower inflation rate, had absolutely no chance of keeping up. This is exactly why so many renters felt completely and totally squeezed. So where does all this pressure on prices even come from? Let's go down into the engine room of the economy and take a look at the different forces that can power inflation. Generally speaking, inflation comes in two main flavors. On one side, you've got demand pull. This is the classic too much money chasing too few goods. Everybody's spending, credit is easy to get, and there's just not enough stuff to go around, so prices get bid up. But on the other side, you've got cost push. This happens when it simply costs more to make things, like when oil prices spike, and the producers have no choice but to pass those higher costs on to you. That huge IGP-M spike we just talked about, a textbook case of cost-push inflation. Brazil's story, though, has this really unique third chapter, something called inertial inflation. And this is a really tricky beast. It's basically when past inflation becomes the main reason for future inflation. It's like the memory of inflation gets baked right into the economy's DNA. And to understand just how terrifying this was, you just have to look at this number. In the year before the famous Plano Real was launched, Brazil's annual inflation hit almost 2,500%. Prices weren't just changing by the week, they were changing daily, sometimes even hourly. It was a vicious cycle, a self-fulfilling prophecy. Everyone expected prices to rise, so they raised their own prices and demanded higher wages in advance, which, of course, caused prices to rise even more. So how do you stop a runaway train like that? Well, the genius of the Plano Real was that it broke that psychological cycle. Before they introduced the new money, the real, they created this temporary, almost make-believe currency, the URV. For a few months, everything was priced in these URVs, which were stable. This gave people's minds a chance to forget the daily price hikes. It broke the domino effect and restored faith that money could actually hold its value. It was brilliant. Okay, so how do governments fight inflation today? Well, they aren't helpless. Central banks have a pretty powerful toolkit, and they have one primary weapon that's designed to cool down an overheating economy. And that main tool is the Selic rate. The best way to think about it is as the economy's master interest rate. It's the rate the central bank uses to lend money to other banks, and it ends up setting the foundation for pretty much all other interest rates on your loans, your credit cards, your investments, everything. So how does this actually work? Well, it's a pretty straightforward chain reaction. First, inflation starts to rise. So the central bank steps in and raises the Selic rate. This immediately makes credit more expensive for everyone. Your mortgage, your car loan, all of it. As a result, people and businesses start to slow down their spending. They borrow less. And finally, with less demand chasing goods, the pressure on prices eases up and inflation cools down. It is essentially the economy's brake pedal. But, and this is a really big but, there's a dilemma. Pushing that brake pedal works great against demand pull inflation, but it's way less effective against those cost push problems we talked about, like a sudden spike in energy prices. I mean, raising interest rates doesn't magically produce more oil. All it does is slow down the rest of the economy, which creates this really painful trade-off between fighting inflation and hurting economic growth. Okay, that's the big picture. But now let's bring it all back home. Let's get personal. How do you defend your own hard-earned money against the silent thief? How can you build your own financial shield? You know, something a lot of people don't realize is that unexpected inflation creates this invisible transfer of wealth. It actually creates winners and losers. As you can see here, it pulls value away from savers and gives it to debtors. So if you just have cash sitting in a savings account or under your mattress, it's losing power every single day. But if you have a big fixed-rate loan, like a mortgage, well, you actually kind of benefit. You get to repay that loan over time with money that is worth less and less. It's a secret win. So the number one rule for protecting yourself is really simple. Don't let your money just sit still. Cash is pretty much guaranteed to lose value. The goal is to find investments that give you a real return, which just means they grow faster than inflation is eating them away. That could mean things like inflation-linked government bonds or real assets like property. And on the flip side, it's the perfect motivation to get aggressive and pay down any high-interest debt you have, especially if the rate on it isn't fixed. So there you have it. We've unpacked the whole puzzle. We know what inflation is, we know why your rent feels like it's from another planet compared to your salary, and we know what tools are out there to fight it. So the final question, that's for you. Now that you know all this, what's the one thing you're going to do differently with your money starting today to make sure it's working for you and not the other way around?